Hey everyone, welcome back to Corporate Decoder. Today we are diving into a filing from iCoreConnect, and let me tell you, it's a bit like a roller coaster ride. It has twists, turns, and might leave you feeling a little dizzy, but fear not, we will unpack it all together. We are looking at a Form 8K, which is basically a corporate breaking news report. Companies file these to tell investors about big events that could affect their stock. In this case, the filing tells us about a new loan agreement and some changes to the company's board of directors. So, first big news, iCoreConnect got a loan. The company entered into a revolving loan agreement. Think of it like a corporate credit card with an institutional investor that is a big money lender. The agreement allows the company to borrow up to $2,180,000. This type of loan is called a revolving loan because the company can borrow the money, pay it back, and then borrow it again up to that limit. The most they can borrow at any one time is $2,180,000. This borrowing comes with a cost, they have to pay interest, and the interest rate is 18% per year. That is a pretty hefty interest rate. It is calculated on a 360-day year, so the interest builds up daily from the moment they draw down any money. The loan has to be paid back on the first anniversary, that is 1 year of when the deal closed. That means that the company needs to have the money to pay back the loan plus all the interest by that date. They can make payments before then, and they can borrow the money again after they pay it back, as long as they do it before the 10th business day leading up to the final due date. There are events of default, that is, things that can trigger the lender to demand immediate repayment. If the company defaults, the lender can demand not just the outstanding amount and the interest, but also an extra 20% on top, as well as any other costs or damages. It's like a penalty for not following the rules. iCoreConnect also promises to try its best to sell at least $5,000 worth of its stock to the public as soon as they can. This is most likely so they can pay back the loan, but it depends on the lender whether they choose to do that. The loan agreement has some restrictions on what the company can do. For example, it cannot buy back more than a very small number of its own shares of stock. The company also can't take on a significant amount of new debt or make large payments without the lender's approval. Here's a twist. If Adam Chambers, Angel Liriano, David Piedra, or Joseph Tung, or whoever replaces them on the board of directors, is removed from the board without the lender's permission, it will trigger a default. It is interesting that a lender is essentially making the members of the board of directors part of the lending deal. Moving on from the loan agreement, there have been some changes to the company's board of directors, the people who oversee the company's strategy and performance. Kevin McDermott resigned from the board. 4 new members, Adam Chambers, Angel Liriano, David Piedra, and Joseph Tung, were appointed to the board. After these appointments, the board committees which oversee specific areas like audits, compensation, and nominations were reorganized. The audit committee now consists of Wayne Kalish, John Pasquale, and Angel Liriano. This committee is responsible for overseeing the company's financial reporting and audits. The compensation committee now consists of Wayne Kalish, John Pasquale, and David Piedra. This committee decides how much the company's executives get paid. The nominating and governance committee consists of Wayne Kalish, John Pasquale, and Joseph Tung. This committee is in charge of finding and nominating new directors and overseeing the company's corporate governance practices. The new board members will be paid according to the company's normal compensation program for outside directors. And it looks like Adam Chambers has a direct connection with the lender that provided the loan to iCoreConnect. So what does it all mean? iCoreConnect has secured a loan to help them keep the lights on, but it comes at a pretty steep price, 18% interest. They are also planning to raise more money by selling stock to the public. But the loan agreement also gives the lender a fair amount of control over the company, including the board of directors. The fact that the company had to get a loan with such a high interest rate suggests that they might be in a somewhat difficult financial situation. The company does need the cash, that is for sure. The lender gets some say in who is on the board. This is not usual, and it may mean that the lender does not have full faith in the company's ability to execute. Overall, it looks like iCoreConnect is working hard to stay afloat. They are raising money, making changes to their board, and trying to grow their business. But they also face some challenges, including high debt cost and some restrictions on their operations. Keep an eye on their future filings to see how they navigate these challenges. Thanks for watching. If you found this breakdown helpful, please like, subscribe, and leave a comment below.